Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today is the man himself, Mr. Michael Becker. Michael, how are you?
Paul, things are going pretty good. Just kind of wrapping the year up. How are things in your world?
Always exciting in our world. So again, Old Capital provides a lot of debt to the communities in Southwest part of the United States. We do a lot of financing on large apartment buildings. One of the things that we're doing this coming up January that we want to have you, if you have the ability to come to Texas on January the 10th, we're going to have an all-day field trip where we'll bring people out that have some interest in investing in multifamily to kind of see the ground floor of how it's done. So we'll have a big bus. We'll put you on there. We'll have 50 people. It's a small group. We want you to come out and actually take a look. So we'll physically walk through a bunch of properties and have you get kind of an idea what it is to invest in multifamily properties here in the Dallas-Fort Worth area. So we look forward to seeing you come out to Texas January the 10th. Again, go to the oldcapitalpodcast.com, oldcapitalpodcast.com, and register for that event. Today in the podcast, we have some friends of ours that we've known for a long period of time. We've transacted with them a number of times. At least Michael has, and we've provided debt for some of the clients that they've sold large apartments to. So in the podcast today, we have two gentlemen from IPA, which is a division of Marcus & Millichap. And so they're going to talk a little bit about what's going on the institutional side of investing, apartment sales, investment sales. So they're going to talk a little bit about what's going on. So the gentleman that leads the group is a gentleman named Drew Kile. So Drew's in the podcast, and his colleague is a gentleman named Michael Ware. So Drew, thanks for coming. Michael, thanks for coming. I'm going to kick it over to Michael, and let's start the conversation.
Yeah, I appreciate you guys joining us. And as Paul mentioned, we've done, dozens of deals together, I guess, over the years. So known. Yeah. And have a great relationship with Mike and Drew. But maybe, Drew, you want to kind of kick it off and give a little background on yourself and the team and let everyone kind of know what you guys do.
Yeah, no, absolutely. So we're a division of Marcus & Millichap. The institutional property advisors side of it typically handles the larger sales. Most of our stuff is $20 million and up. I'd say on any given year, our average sales probably in the $60 million range, 60, 65. Very active in, new Class A sales. So the big developers are a lot of our great clients. And yeah, I mean, we've been kind of building out this team. One of our other partners, Will Balthrop, and I started the current team we have about 14 years ago. And myself and Mike and our other two Dallas partners, Joey and Taylor, run the DFW operation for the team. And then we've got partners on the ground in Austin, Houston, San Antonio, Nashville, and then we do quite a bit in secondary markets as well. But Mike and I are based here in Dallas, Fort Worth, and that's 99% of what we spend our time on day to day is the stuff here.
That's great, yeah. And being a little modest there, they were the number one shop, and certainly in Texas, if not in the country, in 21, 22 time period. You guys, 21 at the peak, you guys probably did 120 transactions, over $10 billion in volume at the peak. Is that something like that?
Yeah, something like that statewide. I know in DFW in 21, we did 81 transactions for a little over $5 billion just in this market alone. So yeah, it's crazy times. And look, the back half of this year has been a nice pickup. We're not quite running at those levels, but we're close. The year won't be near that high, but in terms of just the pace we've seen from kind of Q3, Q4 executions, we're blessed to be here. You talk to our counterparts in other parts of the country and, not near the transaction velocity. And I just think that's one of the big reasons why DFW is consistently ranked as one of the top one or two markets in the country for investment.
Yeah. And then Michael, you have a little bit more of a workforce housing background before you got more in the institutional space. I don't have anything to add on yourself, at least can I hear your voice?
Yeah, no, that's right. I grew up in the bullpen with Drew at Marcus & Millichap starting in 2005. Can't believe it's been that long. And then kind of just gradually transition into new construction, work your way up the food chain. But roots are in workforce. We still have a ton of clients in that space. And I feel like we're a well-rounded outfit because more and more institutional buyers or really shops now have three buckets of capitals: the core plus, and value add strategies. So we like to be well-versed in all of them.
That's great. So, Michael, why are we talking to these guys? I mean, this is, besides being friends of ours, why is this space so important to like the individual investor that may be investing in a Class B and C property, or it could be their first transaction that's going on? Michael Becker, what is your sense about why this group is so important to listen to?
Yeah, I mean, I think a lot of the listeners podcasts do a lot of workforce housing, which is where I started, and buying crappy deals from guys like Michael back, 12 years, 13 years ago, and then transitioned to big, pretty nice buildings. And it's kind of the evolution for most investors, Paul. I think they want to try to go upstream and go upscale, buy bigger, better, nicer, newer. And then, some of these deals that we bought, kind of new properties are now coming A- value add deals. Let's kind of age into it over time, as there's always the next big shiny thing kind of coming around the corner. But Mike and Drew, their team, they dominate Texas institutional properties, and it's kind of used to always kudos to you particular, Drew. Before Mike and Taylor joined you guys, I always thought you guys did a really good job and controlled a lot of Class A stuff in Tarrant County and the Fort Worth side, and then all of a sudden you took over, the majority of the institutional stuff market wide, and it's kudos to your team and your work ethic, and just being relentless networkers and doing good jobs for your clients like SPI. So yeah, with that being said, I thought maybe Drew, you want to kind of talk about, you kind of talked about the pacing of deals picking up, especially second half of 24, but kind of what's the year in review 2024, kind of from your view, both from market fundamentals as well as sales and transactions, kind of your general take.
Yeah, look, I think if you break it up into the transactional side, and Paul, I think one advantage that you've seen on sort of the upper spectrum stuff, the 90s, 2000s, and newer product, is it's been a transactional market, where I think some of the more down spectrum product, we just haven't seen a lot of trades. You've got a lot of people keeping the gloves up, trying to extend and push to keep these deals alive. There's a lot of transactions that went down with floating rate debt in 21, 22 that people are still, working their tails off to create success out of those transactions. The newer property, we tend to lead a little bit, just it's a little more liquid market. It's been a little healthier operationally. So, even like I said earlier, just even around the country, we're doing more transactions and seeing more price discovery here. So, as the year has gone on and we've seen rates finally start to come in, we've seen pricing bottom as transactions have started to happen. That's allowed more capital, that truly institutional capital that tends to be more conservative. They don't get paid to be the first one in. They don't want to step in and buy an asset that in a quarter or 2 quarters later have to write it down on their books if the market's still deteriorating. So as we were able to kind of see a firm bottom in values and see operations hold with a big supply year that we're having this year, that's allowed a lot of capital lean in the A and B plus space, and start to set the data points. And then that creates that kind of snowball of other capital going, okay, now that we're seeing stuff trade, we're seeing our competitors go in and buy assets. Maybe now it's time to lean in. I think next year is just going to be a continuation of the improvement. This is going to be our peak year of deliveries. Next year, we'll see that start to fall off materially. That's only going to encourage capital to lean in more. We're past the election now. If we can get rates to continue it'd be great if they weren't volatile, but even if they stay volatile, but continue to kind of hold, either side of 4% on a 10-year or even work their way down, that just helps everybody lean in and be more active. I think operationally this year, not a lot of rent growth in the A space. Typically most of the stuff we're working on, we've seen 0 to 2 or 3% rent growth on new leases, maybe 2 to 3 or 4% on renewals. Some cases we're seeing, 1 to 2% negative on new leases, but we're renewing 55, 60% of the property, and we're seeing, renewals still in that positive space. So generally kind of flat to up a little bit. Down spectrum, I feel like it's, continue to be a grind. You've got some undercapitalized assets in different submarkets that have created challenges. And I think some cases are starting to improve a little bit. I think people are getting ahead or starting to catch up a little bit on the bad debt, whether it's a better screening or whatever. I mean, you guys would be as close to it as we are. But, it's by no means been a recovery year. I think for the workforce housing space, it's at best maybe been a bottoming year. But we've got some work to do in terms of turning around assets and submarkets to see that more clear path. I think everybody just doesn't know when to step in. If there haven't been a lot of trades, if operations are still deteriorating, do I want to buy now or do I just want to wait? So it's, hopefully 25 starts to become a year where you're seeing more of that stuff turn over. And I think that's just going to help everybody create a little bit of certainty. But the trajectory, at least up spectrum, is good.
What is an institutional investor? What does that mean? You guys at IPA work with a lot of institutional investors. How would you define that, and what are they looking for? Drew threw out a bunch of stuff, but maybe somebody that's listening to this really doesn't understand what an institutional buyer is.
I think it's a wide-ranging definition, but generally speaking, you're looking at your REITs, private or public, your pension fund managers or large fund managers like Blackstone, BlackRock, Avalon Bay, EQR. It's their high capital volumes. They typically have annual allocations and target markets where they're identifying a certain strategy, whether it's a core or a core plus, meaning a risk return profile. There's the core is the trophy assets. They're looking to place and essentially capital allocate. There's no value add. They're looking to make a long-term investment. It's almost like a bond. So those are priced obviously with low returns, very nice real estate, typically newer product in areas that are surrounded by lots of employment and minimal risk. Down to the value add strategy, which is higher risk, higher return. You have to go in and execute a business plan that's more management intensive. And I feel like at this point, all the institutions, like previously mentioned, are covering all the different buckets of strategy. And that changes and varies a little bit between shop, but they are typically your Class A buyers across all the major markets in the U.S.
Yeah. And do you have anything to add what Drew was saying about the market? I mean, you're probably a little bit closer to more on the value add side of the spectrum, I think, than Drew focuses on. At least that's my perspective. Any changes? It seems like we bottomed in the Class A, in my view, roughly 12 months ago, and it seems like we're bottoming in the value add space kind of now.
Yeah.
I hope.
Yeah. So I think we found bottom in Class A probably last year around this time, November, December. We saw a re-entry of institutional capital into the market in April, May with the Blackstone takedown of Aimco. And I think it provided cover for the rest of the institutions to go ahead and start spending money. I think for various macro reasons, Dallas is number one on the list. Primarily, we're getting through the supply line. There's light at the end of that tunnel, and they felt good about making a educated guess or gamble as to, hey, we're going to buy this hold for a year, and then years 2, 3, 4, and 5 of the hold, we're going to actually realize some good rent growth. I think with workforce, it's harder to say because for 3 years, whether the deal was built in 2021 or 1971, everything was a 3.5 to a 4 cap, right? And we kind of got away from the investment fundamentals of the risk return profile, which is if I want to take more risk, I need more yield, more return. And I feel like all those returns kind of sat on top of each other. And now you're seeing the, decompression or, reversion to the mean, so to speak. So if we're, a high 4 cap Class A market in DFW, what does it B and what does it C, right? Historically, it's 75 bips spread, I think, between each asset class. And I think we're still realizing some of that spread as you move down the stack into older product. And I think to Drew's point about the return of capital, it's okay, where do we end up? Like, what does the yield need to be to go buy a 70s deal in South Irving? Like, where do buyers feel comfortable? And more importantly, where can operators and GPs go raise money, which is still to be determined.
So as we kind of are transitioning 2025, what's kind of your view next year? Like fundamentals, you think that we're essentially flat in DFW. Where do you see kind of rent growth, occupancy, things like that go? And then what are you kind of hearing? More capital coming in, more firming up of value? What are you kind of foreseeing as we go in 2025?
I think you will see more capital come in for sure. I think there's a lot of capital that wanted to be active this year that still hasn't quite gotten to their first deal, or they really wanted 2 or 3 and maybe they got 1. And even backing up, Paul, just a little bit, because I think the context is important. We talk about institutional capital all the time, and they're certainly seeing the biggest and best capital be active, the Blackstones of the world, the KKRs of the world, et cetera. I think there's still the majority of Class A transactions, 90s, 2000s, and newer, that are trading in DFW and beyond, might fall in kind of an institutional space for the asset. But that capital, and a lot of times, it's still major syndicators. Mike buys institutional quality buildings and competes with the biggest and best sometimes on those deals. He buys to and from some of those institutions. But, he's generally syndicating to higher net worth individuals. Some of these more quasi-institutional shops are discretionary funds that might have international capital in a fund alongside a pension fund, alongside high net worth family offices. And maybe those family offices are putting in a minimum of $1 million into a fund or something like that. But, that group probably comes across as institutional, even though that capital could still be private that's building up to it. So there is a huge wave of capital that's out there. The estimates have been $100 billion. I would argue the denominator effect has probably even pushed that up, meaning if I have a large fund on Wall Street and I am 20% allocated to real estate, now that my stock portfolio went up 30%, if I haven't put more money out in real estate, I'm under allocated in real estate. That real estate now is only 16%. So not only was I a little behind maybe putting out capital over the last 2 years anyway, the stock market just ran and now I'm even further behind. So maybe that's $120 billion of capital that needs to get out into the marketplace from some of these bigger, more institutional shops. That's going to start to be spread across the Sun Belt a little more. DFW was an easy to invest in market this year because it's one of the most healthy in the country. I think as some other markets start to recover in 25, whether it be in Austin, the Carolinas, Phoenix, you'll see that capital, while the capital will grow in terms of what needs to go out, that capital will start to look in other markets where maybe this year we benefited from a lot of that capital coming here. That doesn't mean there's going to be less demand in DFW. I just think as the appetite grows, so will other markets. The buffet will get bigger, if you will. And I think down spectrum, you're going to see stuff that's going to need to trade, whether it's pushed by the lender, whether it's people that just say, hey, I've got to make a move one way or the other. And I think you're going to start to see that price discovery. And I think there's capital that wants to get in and buy the assets. I think people see opportunity. They've seen a big reset in value, especially in the workforce housing space. And they're just kind of waiting to make sure if it's down 30% that it doesn't go down 35% before they sort of jump all in. But it's going to start with the better assets. I think the tougher assets and the tougher locations are the ones that are going to be the last to kind of bounce back. But the better located 70s, 80s workforce product and the better workforce submarkets will be the first that'll kind of get snagged up. And you'll see, I think, high quality capital roll in there. People that have done it before, maybe they had worked the way up the spectrum. Maybe, Mike, not unlike guys like yourself that used to do it. And then you were buying more new deals, but you've got that expertise that you're going to bring maybe a slightly more sophisticated operation back down into the workforce space and be an early mover in that airspace. And if not you, group similar to you.
I think to provide just a little more context here and some framework. So in 2022, apartment trade volume in DFW was $25 billion. It was a record year for us. In 2023, it was roughly $5 billion, right? So we're at 20% of peak last year. I think this year, what we're tracking, we probably get to 6 or 7 billion, depending on how the year closes out and what pushes in the Q1. What's interesting is the actual capital component or composition of the markets. In 2023, we were roughly 67% private, 11% institutional, and 5.5% REIT with a good chunk of cross-border. This year, still 63% of buyers are private, and you've seen the institutions double to 24% of buyer composition. So what we're seeing is right what Drew's talking about. The institutions are pouring capital back in. That they need to find a home for the equity. It could spread out to other markets as their supply lines look better. But by and large, private capital is still driving most of the activity in DFW. And again, to keep in perspective, if we hit $7 billion this year, right, we're still roughly a fourth or a third in between there of our peak trade volume with supply opening up. And I think the interesting thing is that the thesis, again, is if we can handle record supply, which this is the largest delivery year since 1984. And the downside is, according to our internal research and the M&M and Q4 report, minus 0.4% rent growth. That's a good sign, right? If we're in the brunt of the storm and this is the downside, what does the upside look like when we fully recover? So I think to that point, you're going to start seeing continued increase in capital participation, and it's going to trickle down to workforce as more and more private and call it like your syndicators return.
Yeah, can't wait.
Yeah, we're excited. We're excited. I mean, literally, guys, this is the worst of it, right? And we've all been tracking it. It's crazy to think it's been almost 2 years. Everyone's been kind of holding their breath and waiting for treasuries to react and figure out which direction the country is going to go. We're excited in our shop. I mean, we have weathered the storm. Next year, there might be a little bit more of it as supply delivers. There's a little bit of a lag effect, and you're starting to feel operations, kind of hit concessions or flat negative rent growth in certain pockets. But like, when does that flip from an oversupplied market to really becoming an undersupplied market in DFW? And that's going to be a problem for us.
My crystal ball has been, into Q2. That's what I keep thinking around here. Agree, disagree?
No, I think that's safe. I think the end of Q2 is probably like the end of the large glut of supply delivery, right? There's a little bit of lag effect because those units hit the market and then there's time to absorb. There's still going to be options for tenants, right? And supply is still going to outpace demand. However, how quick does that turn? And another interesting I guess, like fact you have to track is household formation, which we've had record household formation in DFW. No one really talks about that, right? We're going to deliver close to 40,000 units this year, but we're going to also absorb roughly 39,000, which has blown away every record in DFW that we've seen. What's interesting to us is, given the price run in DFW, single family housing used to be our competitive advantage. The affordability and first time home buyers actually had a shot at buying a home, being relatively close to work, could afford the down payment and the monthly. The median home price in Dallas has gone from 290 to 410 in the last 4 years, according to I think the last DMN article I read. And what does that do to renter percentage by household? And I think that's going to push over 60% and unfortunately keep renters in apartments for a lot longer. And if you look at, you go back over the last 15 years, really 26,000 units plus or minus has been our demand line. That's what we need to produce as a metro every year to keep up with the demand line. And if that falls to 3,000 starts a quarter, we're going to be underserved quickly.
Yeah. What are you guys hearing from, you guys sell a lot for merchant builders. What are you hearing about the costs? Because you kind of hear a little mixed bag how certain things are coming in and then certain things really aren't. Or are we seeing any meaningfully lower construction costs today than a few years ago?
No.
Drew, you want to take that one?
Yeah. If you have, it's been low single digits. It's when a developer's going to buy out sign the contracts with the subs. And because a lot of people have been doing pricing, hey, I need pricing on this, but the deals aren't moving forward because they just can't get capitalized. And so now if you go to a sub and you say, look, I've got this capitalized, I am starting this in 4 weeks, I need your best bid. That's where they're seeing maybe 2%, 3%, 1% of prices coming in, but it by no means is a broad-based material change in pricing, and nor does any developer feel like it's actually going to come in. If anything, right now they're worried about tariffs pushing that back up.
Yeah.
And so not only did the bulk of the pipeline in terms of starts get shut off coming up on 2 years ago, that it's not going to restart quickly. I mean, we'll see a slow recovery of new starts, but the market, they need pricing to work its way back up. They need costs to hold. They need debt to come in. There's a lot of things they need to have happen, rents to start really pushing back up before they can close a gap that might be, call it 10 or 20% of where they need to be able to prove up value versus what they can actually deliver today. And they're not expecting any benefit on the cost side. And let's say costs go up 5%, that only pushes out that gap, right? So we're going to be in a long run of probably 2 to 4 years of very healthy fundamentals on the Class A new supply space, which I think is good across the spectrum. And yeah, I mean, some markets, some submarkets, as everything real estate is in a micro market, there's a lot of submarkets around DFW. The last deal that delivered is fully stabilized already. There's no reason to say we shouldn't have a strong 2025 right out of the gates in a lot of submarkets. I think the only thing I would close out with on that is coming out of COVID, the market changed so fast operationally that it was just a slap to the face of managers and operators that they got out of their own way because it moved so quickly. I think one of the things we're going to have to do as owner operators like yourselves is kind of push on our management teams a little bit. They've had a couple of years now of heavy concessions, a lot of supply. It's been a grind, and they kind of have to get out of their own way that, hey, if all the assets in the submarket and bound delivered and are fully stabilized, there's no reason we need to be leasing with concessions again. So kind of changing that mindset and not letting it drag through 2025, sort of the 2024 mindset of, oh, the market's still soft, we have to do concessions. We don't. We can really start pulling back, and it's going to probably take a little extra nudge, I think, from owners to kind of push the management teams to do that, where, coming out of COVID, it just changed so fast that it was just a shock to the system, and everybody said, oh, shoot, I can do it. But so therefore, 2025 will feel better. I think we'll have better operations, more rent growth. I don't think it's going to take off and spike even in submarkets that don't have any more supply, just because it takes a little while for that mental shift to go through, management teams.
So I know it's very disparate and depending on where you're at, what you build, but like what's kind of like a generic suburban location, garden, wrap kind of per unit cost that you're kind of seeing, or a range? What does it take to build a deal today from a cost perspective in DFW?
Probably low to mid 200s for garden. You start adding elevators, you're probably mid 200s, pushing way up to mid to high 200s. You're talking structured garages. It's tough to get anything done under 300 a door, and that would be probably a smaller unit, medium quality, maybe 4-story, and you start talking about more trophy, 5-story, knocked out, expensive dirt, low to mid 300s for wrap. I mean, podium can run up well beyond that as well if you're talking underground parking, things like that. But your 4 to 5 story wrap in a really good location, that dirt's still expensive. Concrete wrap structured parking is still expensive. Those are kind of that low to mid 300s. And I think that's what's gotten some buyers excited. I mean, they're seeing good, high quality, brand new suburban garden deals trade in the low 200s, which is inside of replacement cost. They're seeing really well located wrap product trading in the low 300s when replacement cost is probably low to mid 300s at minimum. And, I think that gives a little bit of reassurance in a challenging market like we're still coming out of to go ahead and pull the trigger. That gives me a warm and cozy feeling that nobody's going to be able to come in and build next to me anytime soon if I'm buying something that costs less than what it even cost them to build, much less build, sell, and make money.
Do you have a sense of when we go from a below replacement cost market to at or above replacement cost? Do you have a crystal ball how long that's going to take?
I don't know, Mike. I mean, I feel like next year is going to be the year. What are your thoughts?
Where?
Yeah, I think next year towards the end, we could start surpassing that level again. Just think the amount of capital participation as more of that enters the market, there's natural yield compression. If treasuries come in, if we can get to an all-in cost of debt capital of 5, I think we clear a lot of inventory and it goes to alternative investment. I mean, this is where the money wants to be.
Yeah.
So.
Yeah, I thought about that a minute ago too, and I didn't say it, but you think about the savings rates, the interest rate you can get on your savings is coming down. You've got a lot of people that haven't had returns of capital from investments. You probably start to see that open up a little more next year. Their alternative investment for risk-free return is dropping. I think that's going to help people lean back in. And, you might not see for the small to medium syndicators a flow of capital, but where it was almost impossible, you start to see more people popping back up with the $50,000 or $100,000 checks to get deals done because they see the light at the end of the tunnel. They see things have bottomed and their alternatives are not as good. And, frankly, their stock portfolio has done really well the last couple of years too. So it doesn't feel like they're, getting hit on all sides.
Yeah. Well, we just raised a little over $20 million, and I was pleasantly surprised that it went reasonably well. Wasn't a complete grind like I was kind of hoping. And I don't know if that's just because there wasn't much competition. No one else is doing it right now, or it's just the mindset that, hey, we want to get some money out. We feel it's a good time. Feel like the bottom's in on the nicer stuff and maybe close on the older stuff. And, it's a moment in time. I kind of coined it a few months ago, like a generational buying opportunity. It's the best time. And since probably 2012, 2011, something like that, kind of what it feels like to me, that we're kind of akin to that. Obviously values are much higher than what they were back then. And no one's going to wave the all clear sign and it's like, it's time to go, mission accomplished, you're good. But I think it's just kind of, just seems like as the supply comes down, more and more capital comes in. It's just the inertia, as you're talking about, and the alternatives getting less attractive because, all-time values on stock markets and 25 times multiples on the S&P 500, whatever it is, and 5% treasuries and now 4% treasuries. So I think just it's going to continue to go better. And then those of us being real local, being in Dallas-Fort Worth, I mean, where else you want to be than more than Dallas-Fort Worth? It seems like this is a great time. We own in Austin. I'm trying to buy everything I can in Austin, but I mean, the volume in Austin is like off a cliff. There's like no one's doing anything there, and no one's selling unless they absolutely have to. So, I think it's a great time to buy there, but got to have to hold your nose a little longer there than you will up here in Dallas because it seems like, lights is just right around at the end of the tunnel, and we're just, mere months away from supply, absolutely falling off a cliff. It's not years away. It's 6 months away or something like that. I think, definitely appreciate that. Paul, do you have anything else to kind of add or wrap up here before we let the guys go?
Back, let's say when these guys joined Marcus and Millichap a long time ago, you had to sell guys out of New York or Los Angeles that were apartment buyers. The first thing you had to overcome is where's Dallas again? And today, I don't think you have that challenge about trying to figure out where the hell Texas is or where Dallas is specifically. But for people that are just not familiar, everyone understands where Dallas and Fort Worth is. But what are some of the better markets in? Let's talk a little bit of micro level. Michael Ware, what do you like? What areas do you like? Drew, what do you like? What areas do you like?
I'm gonna give you a broker answer here. I think
the broker answer.
It depends. I mean, what's your business strategy? What's your plan, right?
Yeah.
And I think that there are different submarkets that correspond to your business plan and your capital structure, like your time of hold. I think generally speaking, the best markets are probably where there's the most supply right now. there also happens to be the most demand. So you have McKinney, Allen, Frisco, Melissa, Anna, the northern suburbs that check all the boxes. So if you're in California or New York, looking to move to DFW, you're looking for great housing, good infrastructure, proximity to your place of work, great schools, and a place to go out and eat and hang out with your friends. And so I think a lot of those northern suburbs, or like in Fort Worth on the southwest side, the Chisholm Trail Parkway has opened up the entire southwest quadrant. And it was a market 10, 15 years ago. It was kind of the sticks. And now you go out there, and we sold, I guess, a record asset in the George earlier this year with a very large institutional buyer coming in and saying, yeah, we'd love to own this long term. And I think 10 years ago, you just would have never seen that group enter that space. So it varies, but we track a combination of a lot of boxes. And regarding demos and ISD, I do, infill, Paul or Mike, you were talking about like why DFW and explaining it. I mean, I say Goldman, Charles Schwab, Bank of America, Wells Fargo, and you're bringing Y'all Street to Dallas Fort Worth. And I think that the city leaders and the regional leaders, I mean, there's real legs and real motivation to make Dallas the financial center of the U.S. And I think that we are in a precarious time in the country where a lot of these traditional states that were the financial centers or core cities have maybe overregulated themselves. And a lot of smart money and smart people are starting to look at Texas as a viable alternative to relocate their corporations. And honestly, we are all on this call very lucky to be in this sector, in this region, and in this city, because I think that a lot of smart people who are well capitalized are seeing that DFW has a lot of future and a lot of runway.
Historically, we kind of answer that, or I answer that question at least, is what submarkets do I want to look out for? Because really the broad DFW market, the large majority of the submarkets are really good submarkets that are very healthy, that have all the drivers that you want. So sometimes it could be hard to pick and choose 2 or 3 that are good. I think there's other ones you just might need to watch out for. And I think if you're looking, and Mike's exactly right, some of that, the further out northern suburbs, especially up in Collin County, you do have a little bit more supply. 2025 might be a little bit more of a grind, but even medium to long term, that submarket's going to be excellent. And those municipalities are pushing back on what it takes to build in their submarket. Salina, for example, you can't do a garden deal anymore in Salina. So if I'm buying a garden property in Salina, I might be fighting with some supply right now, but my outlook is really good. I've got a city that went from pro-development to going, no, hang on. You want to build here, that bar just went way up. So I feel pretty good about the ability to withstand supply on a go-forward basis, but I've got to go in eyes wide open. That basis might be good. 2025 might be a grind. So I just got to watch it. The long term, that's a great submarket. I think if you're in the workforce housing space, you really got to look, in my opinion, on what's going on in that submarket with some of the other owners. I think if I'm going into a submarket that has multiple properties that are really behind the power curve right now in terms of being undercapitalized, they've got a lot of vacancy, they've got a lot of down units, I've got to be prepared for that. So if I'm going into a little bit of a healthier market in North Irving that doesn't have as much of that compared to another submarket that's got 4 or 5 properties that are really, really lagging, and that's where I want to look at. So it's not that if North Arlington's struggling a little bit more than North Irving, doesn't mean I'm going to go buy North Arlington. I just got to go eyes wide open, and I just need to know what the lay of the land I'm going to have to compete with. But look, I always joke, if you invest in the stock market, it's been proven that dollar cost averaging, putting the same amount in every week or every month, is going to outperform over time. I give Michael Becker a lot of credit, privately and publicly, that I think he does a great job of being active in the market through cycles. He hasn't been sitting on his hands for the last 2 years. He's been buying and he's been selling, and he's made his investors money by doing that. There's a lot of people that want to buy low, I want to sell high. That's the way real estate goes. Well, not really. There's a lot of people that didn't want to buy when the market was going up, while other people bought, and they turned around and sold it 2 years later, made a ton of money when the first guy was saying it was too expensive. Right now, they're saying, I'm not going to go. I'm waiting for more blood in the streets. Well, guess what? Before that blood hits the streets, the market might bottom. So, one, I think it's good to always be active. I certainly feel like while there's still some challenges ahead at different levels at different parts of the spectrum, now is a time people should be really looking to go out and invest. If you say you want to buy low, this is that time. And maybe in workforce, are you 5% below, ahead of the bottom? And maybe in Class A, you're 5% above the bottom, but still you're right around the bottom. So don't wait for the perfect moment. If you have capital you're trying to get into multifamily, now's a good time to be doing it. You're going to look back 3 to 5 years from now and be glad you did. And I don't think waiting around until 2026 is going to be the time. I mean, the ship will have sailed. You'll be buying on a strongly rebounding market, and it might feel better. But in terms of trying to dollar cost average and maximize some of your returns, now's a great window to be going in.
Here's a great little, I guess, one-liner we heard from a client, and his summarized the market perfectly to me. In 21 and 22, all the models said yes, buy it. Intuitively, it's like, man, this is really expensive and pretty risky. Now the model says don't do it, but intuitively, it's like, hey, this is a buy market. You should do it. And he said, look, if everyone waits for their model to give them the green light, then you're going to have 150 new buyers having the same thing. And what's going to happen? Yield's going to come in. I thought that was well-versed and delivered and summarized a lot of complex, bullets in a very simple form. So
it doesn't feel good right now. So it's hard to pull the trigger and show confidence. So those of us that are doing it, I keep telling myself we're going to get rewarded, and I truly believe it. I mean, it's just math. It's a matter of time. Supply is going to stop. And
it's crazy, right? I think everyone's kind of a student of business here, and it's the number one rule is be greedy when everyone's scared and running out, and be scared when everyone's being greedy. And I feel like everyone says it, but very few people actually execute and practice on that.
Yeah. Because this you buy it, then your rents go down 5%. You look like an idiot, like. And I was just a little early, but 5 years from now, it won't matter. That 5% either above or below the bottom, like Drew's talking about, it won't matter in 5 years from now. And I think it's a really good point to put a final point on what Drew was saying. As we're kind of looking to go back in time, buy some older stuff, that's number one, is who's my neighbor, right? So I won't name names, but there's, 4 or 5 shops that if they're next door to me, I ain't buying, like it's got to get cleared out, or it's got to be really cheap. It's got to be really cheap to make that make sense. So that's definitely a point as you're looking at the workforce housing is who's your neighbor, because they can bring the whole damn submarket down. As Paul Peoples like to say, if you buying a sea of C's, just a apartment city of workforce housing, your neighbors matter quite a bit for sure.
Oh yeah.
Any final words, Michael Ware, and then I'll ask the same thing to Drew. Things that you want to tell somebody that we haven't discussed on this. What do you think is important?
I guess what's important for us is have your capital stack, lined up. And again, just from the broker perspective, when we're picking buyers right now, it's not always necessarily who has the highest offer. It's who can actually get the deal closed, who's done their homework, have they lined debt up, they talk to you guys, right? Who's your equity? And I mean, really, who is your equity? Don't tell people you have it and then go out and try to round it up. You need to have everything organized. I think it's paramount on the buyer calls today. And, sellers have buyer hats as well. They understand the market. They understand the environment. So don't be tricky or cagey, lay it out there, I think, and really show everyone a path to closing and execution. And I think that despite what a lot of people may say, every deal we're taking out is getting done right now. The market is moving despite some of the headline news. And I think there's some really good opportunities that people are going to miss out on if they don't participate and get back out there.
Great information. Drew, what is something that we didn't mention that you think is important for people to hear?
I think a lot about the operations. That's the fundamental of what we're selling, right? Is cash flow and the numbers on the page. And I think that market's going to improve as we go forward. As I mentioned earlier, staying on top of the management teams and getting out of the sky's falling mindset and back to we got to go take advantage of the market and push rents where we can. So I think really digging back into the fundamentals, I don't think 2025 is going to operate the same as 2024 did. So what are you doing to, make changes in your operations if you're running these assets to take advantage of the market? I think it's a people business, and there's a lot of turnover, on the operational side. It's hard to keep good people. And so I just think it takes a lot of resource, time, and effort from owners to create a successful on-the-ground operation. And so whether that means hiring and spending more on your internal asset management, spending more personal time as an operator on your asset management, I think assuming that somebody else is taking care of it at the management level, not that we don't have great management and operators here in this market, it takes a village. And so I think as the market transitions, really leaning and pushing with our management teams to, get the desired results going to be key. And the capital markets are going to be what the capital markets are. We're not going to be able to change the treasuries. But what we can do, and that's the great thing about the multifamily business, if I signed 10 bad leases in a retail shopping center, I'm locked into those leases for the next 5 to 10 years. But I can make changes multifamily day to day, week to week. And so, drilling back in going into 2025, I think the on-the-ground teams to try to get the best result is going to be very important as the market shifts back to a more positive area.
Michael Ware, if people want to get in contact with you guys, what's the best way for them to get in contact with you and get on your list to see some of the great reports that your team of economists and data people push out to the kind of the average buyer? What's a good contact for you guys?
Yeah, I'd say email us anytime. I'm mware@ipausa.com. Drew is dkile, Kile, at ipausa.com. And we're here all the time working, and happy to talk to anyone who's inquiring about the market or has questions. So.
We also have a website too. I mean, we've got the national IPA website, but just for our team, IPATXMF.com, IPATXMF.com. We'll take you to our website. All of our stuff's out there, all of our contacts info out there. And yeah, I mean, look, we've had a chance, and I think some of it comes to, I mean, I just rolled over my 20th year with Marks & Millichap. So, I mean, inherently, we've grown up with the smaller private investors. Our company has grown up with the smaller private investors. We started out in 71 selling small fourplexes in California. And, you know, we're a large publicly traded company now. And so I say that because I think we all have the mindset of kind of our Marks & Millichap roots, and we've worked with a lot of clients over the years to go move up spectrum. And so I think we've gotten feedback from a lot of people over the years. Hey, you know, I tried to buy this deal from that shop or that deal from that shop. They wouldn't call me back. They wouldn't give me the time of the day. They wouldn't give me a fair shake. And we have a lot of great clients that we've grown up with that I think are great clients because we did. You know, we're always happy to help the next generation working the way up. And anytime we can be a resource, we want to be that for the marketplace.
Great information. Thanks, Drew. Thanks, Michael Ware. Michael Becker, any final words before we say goodbye?
No, yeah, appreciate all the personal and professional friendship over the years, and looking forward to a better market next year. So can't wait. Can't wait.
Amen.
All these deals we've been buying, hopefully metals improve, and we sell a bunch of deals in the coming years, and we all make a ton of money. That's my hope.
That's great. Okay, Drew Kile, thank you very much. Michael Ware, thank you very much. Of course, the man himself, Mr. Michael Becker, thanks. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.